tax loss harvesting. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And this is a great investment video for all of my winners in the stock market or my soon-to-be winners. Tax loss harvesting is a strategy used when you have capital gains from the stock market or any other type of capital asset, and you're trying to lower your tax bill. So if you're an investor or planning on becoming one, you will not want to miss this video. So let's start right at the beginning. Tax loss harvesting. What is that? Tax loss harvesting involves selling stocks, mutual funds, ETFs, or any other capital asset at a loss in order to offset any other capital asset gain, such as stocks, mutual funds, and ETFs. A capital gain occurs when you sell a capital asset for more than what you purchased it for. And a capital asset is almost anything. It can be stocks, mutual funds, ETFs, or it could even be a boat or an automobile. Essentially, you've sold a capital asset at a gain. You now have a profit. And what you're trying to do is find the losers in your portfolio. That is the capital assets that you can sell for a loss in order to offset gains you have in the same type of income, which is capital income. When you realize a capital gain, the amount of tax you pay varies. If you've held the asset for more than 1 year, that's a long-term capital gain. If you've held it for less than 1 year, that's a short-term capital gain. A long-term capital gain is taxed at a preferential tax rate, either 15 or 20%, depending on your total income. A short-term capital gain is taxed at your regular marginal tax bracket rate. So there's usually two incentives with capital gains. The first one is to hold it for at least a year to get the preferential tax treatment of either 15 or 20%. And the second is to harvest your losses, right? Do a tax loss harvesting on some of the losers in your portfolio in order to offset the gains. Tax loss harvesting is a strategy where the investor can still maintain the same portfolio, right? Because they were already at a loss on that asset. However, they're reducing their income in the current year, which is leading to less taxes. Let's do a quick example. Let's say an investor purchases a stock for $500. They later sell the stock for $600. 600 minus the $500 purchase price is a $100 capital gain. This is typically charged at capital gain tax rates, assuming that they've held that stock for at least 1 year. However, this same investor has now identified that they have some stocks that are at a loss. For example, they have one other stock that they purchased at $400 and is currently worth $300. 300 minus 400 is a $100 loss. That investor might choose to sell that stock even though it's at a loss, because that $100 loss would now offset the $100 gain they earned from the other stock sale that was a gain. Now let's add a little bit of complexity to this tax loss harvesting. There's a common misconception that if you just sell all the stocks you have at a loss, you can fully deduct that. However, that's not true. You see, capital losses are limited to a maximum of net $3,000 per year. What does that mean? Basically, you can take all of your losses, but you can only end up in the negative $3,000. Any additional loss will be rolled forward for the next 20 years. So let's do another example. Let's say that you sell one stock for a gain of $20,000. And you've identified another loser stock that if you sell, you'll lose $25,000. You do that. So $25,000 loss, $20,000 gain, you net them together, you end up with a net negative of $5,000. Going back to the original rule I mentioned, you can only take up to $3,000 net negative, but here in this example, you have 5. What can you do? You can take 3 of that $5,000 loss, deduct it this year, and the remaining 2 will be deductible against future gains in a future year for up to 20 years. We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.